Yeah, so thanks for having me on, Sarah. Look, in terms of the setup, banks are coming off a strong year in 2021. That outperformance has continued so far this year. I know they're down a little bit to start the year, but they're outperforming the broader market by a pretty wide margin. And that optimism is going to continue given the expectation around policy trajectory. 6 hikes this year, 3 hikes next getting baked in. History tells you the overweight banks trade typically works through the first 4 or 5 rate hikes. But the banks typically lag thereafter, particularly in periods of persistently high inflation. You get the benefit of higher rates, but then the dark side of higher rates starts to trickle in, whether it's higher credit costs or weaker fee income in a slowing economy. So from our point of view, I'd say I'm comfortable being overweight the banks here through at least the first 3 or 4 rate hikes. However, my preference is still to be long rate-sensitive plays with limited credit exposure. And the best play on that are the names that are actually up the most as we speak. Names like Schwab, LPL Financial, and Morgan Stanley. Wealth management firms that just don't have a lot of credit exposure, but have significant asset sensitivity.
Those are the best performing financials right now. As you mentioned it, Schwab up 6%, Morgan Stanley up 6%. Explain why. What's the linkage there with higher rates and why they would do better than, say, a Bank of America, which is typically mentioned as one of the biggest beneficiaries from higher interest rates and loans?
Yeah, and look, Bank of America is certainly rate sensitive as well. But the challenge is, and you guys were talking about this on the program earlier, there's still recessionary risks that are steadily building, right? And persistently high inflation, concerns around yield curve inversion, all of these issues collectively suggest that recessionary risks are rising. And against that backdrop, you really want rate exposure, but names that also have much more resilient earnings profiles under stress. Charles Schwab is going to benefit from increased volatility. Their cash builds in periods where markets are declining. And so I could even make a case that their earnings will improve under greater stress. And other names like LPL and Morgan Stanley will see modest earnings pressure, but there are natural hedges or offsets in the model that really support being long those names while avoiding potential recessionary risks or pressures that we could see in the traditional banks like B of A and JP Morgan.
Do the banks need yields to continue to rise? We're seeing it today. We've seen it lately, but it doesn't always happen so intuitively with the Fed raising rates, especially with some of the broader economic fears around global growth and even here in the U.S. Do we need that to work?
Well, the good news, Sarah, is that where yields are today are well above the back books for these banks. So said differently, most of the banks reinvested in securities around 125 to 150 basis points. Those same proxies are now 100 basis points higher. But where yields are, to me, is less relevant in a vacuum. You really have to look at the shape of the yield curve. That's going to matter far more. We are seeing some flattening today. If we do end up seeing inversion at the 2s, 10s, that's where I'd be a little bit more concerned. That's where I'd lighten up a little bit more aggressively on some of these bank stocks.